Hello friends, welcome to JK Shah classes. Today we will be discussing a new chapter, Double Taxation Avoidance Agreement. It is chapter 9, Double Taxation Avoidance Agreement, DTAA it is called as. Also called as Double Taxation Avoidance Treaty, DTAT, or Double Taxation Avoidance Convention, DTAC. Now, as the name indicates, the idea is to avoid double taxation. So first of all, the question arises, what do we mean by double taxation? Double taxation means same income getting taxed twice in the hands of same person or same assessee. Same income getting taxed twice in the hands of same person. How is this possible? This is possible only in a situation where assessee is resident of one country and derives income in another country or derives income from another country. We know pretty well, world over, there are 196 countries. Out of 196 countries, wherever there is tax on income, everywhere all such countries including India, rules for charging tax are the same. Tax can be charged on a particular person either if that person is resident in that country or that person has derived income from that country. Either place of accrual should be in that country or the place of residence should be in that country. For example, Justin Bieber from Canada, he is resident of USA, he comes to India, earns income. Can Indian government charge tax to him? Answer yes, because he is, though resident of USA, he has earned income from India. Now how double taxation is possible? Double taxation is possible because Indian government will also charge him tax because he has earned income in India, and US government will also charge him tax because he is a resident of USA. Vice versa situation, I am resident of India, I go to UK to take lectures, UK I earn income, UK government will also charge me tax because I have earned income from UK. When I come back to India, I am resident of India, global income is taxable, Indian government will also charge me tax. So that's our second point. How is double taxation possible? Possible only if assessee is resident of one country, derives income from another country. So what to do? Double taxation can cause a very big financial harm to the assessee concerned and it will create prejudice for him. To avoid that, the governments of two countries will come together, enter into an agreement. That agreement is called as Double Taxation Avoidance Agreement. There are two types of double taxation. Before we proceed further, which two types of double taxation? One is juridical double taxation, which is considered as a genuine double taxation or a real double taxation. Second is economic double taxation. If it is economic double taxation, then this chapter does not apply. Chapter 9 does not deal with economic double taxation. We know about it. So what is economic double taxation? What is juridical double taxation? So economic double taxation is a situation where same income will get taxed twice in two different countries or two different jurisdictions, but in the hands of two different persons. Same income gets taxed twice in two different countries in the hands of two different persons. But then how is it double taxation then? In order to be called as double taxation, it should be same income in the hands of same person. If two different persons are involved, then how is there double taxation? So answer, internally those two people are one and the same. On paper they are two different people, but internally they are one and the same. For example, you are Mr. X, you acquired shares of some foreign company, let's say Tesla USA. Now Tesla is a US based company, foreign company, Tesla Incorporation, and you are Mr. X. Who is the real owner of the company? Answer, shareholders. Who is the shareholder? You are the shareholder. You being a shareholder, you are part owner of the company. Company has earned some income, let's say $100 crore, and company paid tax $30 crore for example, and company is left with $70 crore. From this net of tax income, after paying 30% tax, company distributes dividend. You being one of the shareholder, you would receive dividend. You received 100 lakhs as dividend rupees, on which you will also be liable to pay tax in India. Shareholders are taxed for dividend. Say you are paying 30% tax in India, you are left with 70. The amount on which you paid dividend tax, the amount of dividend on which you paid tax is coming from Tesla, on which Tesla has already paid the tax. On paper, there are two different people paying tax on the same income, but internally shareholder is considered to be the owner. Therefore, tax paid by Tesla is as good as tax paid by you, and accordingly you are getting taxed twice. But this kind of double taxation is called as economic double taxation, and same example I have given here, whatever I describe you. This chapter does not deal with economic double taxation. If it is economic double taxation, chapter comes to an end here only. If it is juridical double taxation, matter will proceed further. Juridical double taxation means same income getting taxed twice in the two different countries in the hands of same person. This is real double taxation. If it is juridical double taxation, then there are two methods of providing relief to such people. One is unilateral relief, another is bilateral relief. Unilateral relief, as the name indicates, unilateral means one person providing relief. It is governed by section 91 and is applicable when there is no DTAA between Indian government and the government of that foreign country. On the other hand, bilateral relief is governed by section 90 and it is possible when there is a DTAA between India and that foreign country. As the name indicates, here bilateral means two people, both the countries combined together will enter into agreement and provide relief, and here only one government will come forward. Naturally, which government? There are two governments or two countries. One is country of source and one is country of residence. This relief, unilateral, under section 91 will be provided by government of residence or country of residence. If it is bilateral relief, then under which there are two methods, both the countries will come forward. There are two methods to provide relief. Which two methods? Tax credit method, which is popularly abbreviated as TCM, and tax exemption method. Here, as the name indicates, tax exemption method means a situation whereby any one country will charge tax and the other country will exempt. Ideally, which country should charge tax and which country should exempt? So, first priority will be given to country of source. Wherever there is a source of income, that country will have a right to charge tax. But normally, however, as per DTAA, some different methodology can be agreed upon, meaning whereby for particular income, it may be specified in the DTAA that for this income, country of source will not charge tax, country of residence will charge tax. So, as the name indicates, any one government will charge tax, other government will exempt. What happens under tax credit method? Here, both the governments will charge tax, both the countries will charge tax, but any one of them will give credit of the tax paid in the other country. First, you pay tax in both the countries. Whatever tax is paid in this country will be given as a discount or will be given as a credit in this country. Which country will give credit and which country will charge tax first? So, answer logically, normally country of source will charge tax first and country of residence will have to give credit of the tax paid in the country of source. Here tax will be levied by both the countries, but any one country will give credit. This is also called as foreign tax credit, FTC. India has entered into agreements with 98 countries. Out of 98 countries, with most country, India follows this particular method, TCM, tax credit method, whereby both the governments receive some amount of tax. Tax exemption method is also called as total compromise method or full exemption method or total compromise. Here one country will make total compromise, only one country will receive full tax, other country will have to compromise. That's why most countries including India prefer tax credit method over tax exemption method. Okay, now under tax credit method what exactly happens? So one country will charge tax first and the other country, that is country of residence, will give credit for the tax paid in this country. However, the credit shall not exceed the amount of tax payable on that income in that country. So let's try to understand with the help of couple of examples for tax credit method. For example, Mr. X is resident of India. He is resident of India just like you and me. He goes to USA and earns income of 100 lakhs. In USA, tax is 22%, everything I am keeping in terms of Indian rupees to have a better understanding. 22 lakh is the tax paid. How much will be left with him? He will be left with 78 lakhs. He will be able to repatriate back to India only 78 lakhs, but tax paid in India or outside India will not be allowed as a deduction. Not allowed as a deduction. As a result, what will happen? In India, how much will be taxable? According to section 40 clause A subclause 2 PGBP chapter, tax paid on income whether paid in India or outside India will not be allowed. Therefore, when he comes back to India, income in India will be deemed to be full 100 lakhs. In India, suppose tax rate is 30%, tax payable will be 30 lakhs. However, India being country of residence will not charge tax on full 30 lakh. India will give credit under section 90 of the credit of the tax paid in USA. Tax paid in USA is 22 lakh. In India, this person will be liable to pay only 8 lakh tax. Balance tax payable will be 8 lakhs. Simple language, the tax paid in USA and tax paid in India combined together will be 30 lakhs. Combined together, he will end up paying that much tax, which is higher as in terms of rate. In terms of rate, this country charges 22%, this country charges 30%. Which rate is higher? 30% is higher. Ultimately, what he ends up paying will be 30% of income. Simply, USA is charged tax first, the country of source, and India will give credit, but India will not give credit of more than 30 lakhs. Here credit is 22 lakh, therefore full amount of credit will be allowed. Let's take a reverse example. Here person was resident of India, comes to or goes to USA. Let's take reverse example. Supposingly Mr. Y, second example, he is a resident of USA, just like Justin Bieber or any other pop singer or musician, artist. Foreign artist comes to India, earns income of 100 lakh Indian rupees. India charges tax 30%. He will be left with 70 lakh rupees to take back home. However, just the way in India, income tax is not allowed as a deduction, irrespective of which country are you paying. Same way in USA also, income tax is not allowed as a deduction, whether paid in India or outside India. So in USA, income will be deemed to be 100 lakh Indian rupees in terms of Indian rupees. Suppose in USA tax rate is 37%, US government should have charged 37 lakhs as tax. But US government, now this time it is the turn of US government to offer credit. In the earlier example, Indian government gave credit. Now US government will give credit of tax paid in India. Tax paid in India is 30 lakhs. US government will give credit of 30 lakh. Total tax payable in USA will be 7 lakhs. So the total tax paid by him in India is 30 lakhs. In USA is 7 lakhs. Total 37 lakhs he is paying. How much tax he will end up paying ultimately? Under this method, both the countries will get little bit tax. Nobody will have to make 100% compromise as compared to tax exemption method. But my question is, how much is the total tax paid? Total tax payable in both the countries combined together will be the higher of the tax rate in both the country. India 30%, US 37%. US rate is higher. So 37% of 100 lakh, the tax ultimately paid by him will be percentage wise that much as the higher of the two countries. However, if you observe both the examples, the left hand side country was a country of source where the tax rate was lower than the tax rate in the country of residence. Therefore, full amount was allowed as a credit. Same way here, India charged 30%, second example, US government charged 37%. So from 37 we could claim full 30 lakhs. However, what if the tax rate in USA is 37% and in India it is 30%? Then what will happen? Then the third example, Mr. Z, he is resident of India, goes to USA, person like you and me, earns income of 100 lakh. US government charges 37% tax, 37 lakhs. Though he is left with 63 lakhs, Indian government will charge him, or Indian government will consider income to be full 100 lakh. In India tax is 30 lakhs. Now it is US government's tax 37 lakhs which will be allowed as a credit in India. Credit of tax paid in USA will be allowed in India. 37 lakhs. However, tax on this income in India is only 30 lakhs. So Indian government will not allow full credit. Indian government will allow 37 lakhs restricted to 30 lakhs, and accordingly tax payable in India will be nil. Why full 37 not allowed? If full 37 is allowed, 30 lakhs is tax payable in India. If 37 lakhs is allowed, then there will be 7 lakhs of refund. Who will pay that refund? Tax which is paid in USA, Indian government will not refund that. Indian government will at the max allow the relief or rebate to the tune of tax payable in India. That is the whole story. Okay, so that is done. Now coming to unilateral relief. Unilateral relief is possible in a case where there is no DTAA. There are many countries in this world with whom our government has not found it necessary to enter into treaty. Why? Maybe not many Indians go to those countries, or the income generated and remitted back to India from such countries is very negligible amount. That's why it is advisable, or the cost benefit ratio will not match. That is the reason Indian government has not entered into agreement. In such situation, only one government, that is Indian government, will provide relief unilaterally, relief from double taxation. Here what will happen? The tax, this is similar to tax credit method. Tax paid in foreign country will be allowed as a deduction from the tax in the country of residence. This is also called as FTC, foreign tax credit. This was also called FTC, this is also called FTC, and the calculation methodology is same only. Whether tax credit method or unilateral relief, your answer will be same. How to calculate? So first of all, this relief is possible under section 91. This is 91. DTAA is there, then 90. DTAA is not there, then 91. In exam, 99% question will be on unilateral relief, section 91. 4 conditions to be satisfied, then only relief is available, and there are 6 steps to find out the relief. Which 4 conditions? Understand, condition 1, assessee should be resident of India. If assessee is resident of India, then naturally second condition would be income should have been earned or accrued outside India, which is not deemed to be accruing arising in India. Assessee is resident of India, income is earned outside India. What if income is earned in India? Answer, if income is earned in India and the person is resident of India, then how there can be double taxation? Only Indian government will charge tax. Therefore, assessee should be resident of different country, income should be from different country. Assessee is resident of India. Second condition, income is earned from country outside India, which is not deemed to be accruing arising in India. Not only that, income should be taxable outside India, there should be tax actually paid or deducted from such income outside India. Tax is paid or deducted in such foreign country, and ultimate condition is no DTAA between India and that foreign government. If DTAA is there, then tax credit method or tax exemption method will apply, as the case may be. DTAA not there, then only this relief. 6 steps to find out a relief. Step number 1, find out net taxable income. And net taxable income, NTI, would mean Indian income plus foreign income, both combined together, minus any exemption or any chapter 6A deduction or any other deduction. That will be net taxable income. Second step, on this net income, find out gross tax payable. Gross tax would mean including surcharge and health and education cess, but before claiming TDS, TCS, advance tax, self-assessment tax, MAT credit, AMT credit, don't claim any of them. Simply basic tax plus surcharge if any plus health and education cess on the total income. Then step number 3, find out average rate of tax. ART. ART would mean average rate of tax would mean step number 2 is what percentage of step number 1. Suppose Indian income is 10 lakhs, foreign income is 5 lakhs, total income is 15 lakh, and there are no chapter 6A deductions available. Second step, find out gross tax. Gross tax under new scheme or old scheme, depending upon whatever is chosen by assessee, it will be given in the question. If not given, then make suitable assumption and proceed further. If the question is on individual, an institute does not clarify whether new scheme is opted or the old scheme, then we know pretty well new scheme is by default. Accordingly, go ahead, write your assumption. See, under new scheme, tax payable works out to be 1,45,600. Next step, ART. ART means find out 1,45,600 is what percentage of 15 lakh. Supposedly it works out to be 9.18%, hypothetically 9.18. So we are actually interested in this. How much is the tax on the given income in India? In India, tax is not charged at one particular rate. Tax is charged at different rates under different schemes and with different surcharge rate. Therefore, tax rate is not uniform in India. Therefore, in order to find out how much is the tax in India, we had to follow these 3 steps. The conclusion of these 3 steps is to find out how much is the tax on such income in India. Step number 4, find out on the same income how much tax is paid or deducted in foreign country. Find out rate of tax on foreign country. This will be readily given. If not given, then some hint will be given whereby you will be able to find out. Now make a comparison between Indian tax rate and foreign tax rate. Foreign tax rate is given to you as, for example, 20%. Whichever rate is lower, Indian tax rate which is on an average, foreign tax rate which is readily given, find out lower of the step number 3 and 4. And finally, step number 6, relief under section 91 will be equal to the doubly taxed income included in NTI, that is foreign taxed income included in NTI. What do you mean by included in NTI? I will explain it to you with the help of some example. This is the place where most students go wrong. You will have to take care of this. How much is the foreign income? Foreign income is 5 lakh rupees multiplied by lower of the rate of tax. Lower is 9.18%. So 5 lakhs into 9.18% will be 45,900 approximately, or whatever is the amount approximately. Let's not get deeper into it. Let's not waste time in actually calculating. Last step, in case you want to find out or if asked in the question, final tax payable. Final tax payable will be equal to the tax so found out in step number 2, 145,600. 145,600 minus this relief under section 91, under section 90, 45,900, whatever is the answer will be the final tax payable. Under section 91, 6 steps plus 1 extra step for computing tax. Most questions will come on this. However, when you are computing relief under section 91, rule 128 will be applicable. It is called as foreign tax credit, FTC, read with section 91. However, certain points to be noted. First of all, whether it is section 90, DTAA is there and tax credit method is followed, or it is section 91, whichever section you claim credit, form number 67 to be filled up. How income tax department will come to know how much tax is paid in foreign country, when did you pay, whether it was deducted or paid. If you are paying tax in India or if it is deducted in India, then on income tax portal in form 26 AS, all these details will be reflected. Self-assessment tax, advance tax, TDS, everything will be reflected on income tax portal. But when you have paid tax outside India, then there won't be any information available in Indian income tax portal. Therefore, assessee will have to lodge a claim of foreign tax credit by furnishing form number 67 read with rule 128. This form is to be submitted electronically before the due date of filing IT return as well as before the actual date of filing IT return. However, form 67 was recently introduced somewhere in 2017. It's just been 7 years now. So for initial period, CBDT had provided relaxation that many people were not aware of these new rules regulation. So CBDT relaxed the date. Otherwise, for current year AY 25-26, form 67 to be submitted electronically before the due date of filing return as well as before the actual date of filing the return. FTC is to be claimed for each source of income individually and not for all the incomes combined together. You have 3 sources of foreign income, then for all of them you claim independently. Okay, now while calculating doubly taxed income included in NTI, last step, step number 6. Step number 6, if you read the language, it says doubly taxed income, but it doesn't say doubly taxed income, it says doubly taxed income included in NTI. So it should be doubly taxed plus it should be included in NTI. What do you mean by doubly taxed? So when you are computing foreign income, step number 1, understand very carefully, you should be applying Indian taxation law while calculating doubly taxed income or foreign income. For the purpose of double taxation, calculation shall be made as per Indian taxation law and not as per foreign tax law. For example, you are being provided that foreign income from foreign country, income from country X is 12 lakh rupees, and there was a loss in the same country, loss of 4 lakh rupees. So net income which you will bring back to India will be 8 lakhs. However, 4 lakh is not allowed as per foreign taxation law, not allowed in country X, but in India it is allowed. So what would you do? In country X it is not allowed, but in India it is allowed to be set off. What would you do? You will allow or not? Answer, allow this. Indian taxation law to be followed and not foreign taxation law. In other words, supposingly in foreign country it is not allowed. Suppose if I change the example, if I tell you it is allowed in foreign country, fully allowed, but in India out of 12 lakh only 2 lakh is allowed. It is IFHP laws, section 71 subsection 3A, for example. Then what to do? In foreign country full 4 lakhs allowed, in India only 2 lakhs allowed maximum as per section 71 3A. Answer, allow 2 lakhs, whatever is the Indian tax law. Another example, say you have IFHP rent from foreign country 10 lakh rupee. As per law of that country, full 10 lakhs is taxable. In India, 30% standard deduction is allowed, 3 lakh rupees. In India, 7 lakhs only is taxable. In India, this is allowed. Foreign country, there is no such concept of standard deduction. What to do? Answer, 7 lakhs taxable, follow Indian tax law. Say for example, another example, salary income from abroad, 10 lakh rupee. In India, 75,000 of standard deduction is allowed under section 16 clause 1A from salary income under new scheme, or 50,000 under old scheme. In India, 9.25 is taxable, but in foreign country, entire 10 lakhs is taxable. What would you do? You will allow standard deduction or not? Answer, yes, allow standard deduction, follow Indian taxation law and not the foreign taxation law. Next, when you are computing income, remember only that much income is to be taken into account in this step number 6 formula. Step number 6 very clearly states only that much doubly taxed income, it should be doubly taxed income. When can it be doubly taxed income? The answer, one shortcut formula. If you don't understand the concept, only that much income will be considered as doubly taxed income which is common between two countries. For example, actual income is 10 lakh rupees if it is IFHB income. How much is taxable in foreign country? In foreign country, entire 10 lakhs is taxable, for example. And how much is taxable in India? In India, standard deduction is allowed 30% and 10 minus 3, 7 lakhs is taxable. Then in this example, how much will be considered as doubly taxed income? Doubly taxed income will be equal to common income, whatever is common. In one country 10 lakh is taxable, another country 7 lakhs is taxable. How much is the common income? Common income is 7 lakh, so doubly taxed income is 7 lakh. Relief will be allowed under section 91, or tax credit will be allowed only with regards to tax on this 7 lakhs, either as per Indian average rate of tax or foreign tax rate which is readily given. Another example, say salary income. Salary income is 12 lakh rupees from abroad. In foreign country, full 12 lakhs was taxable. In India, standard deduction is allowed and only 11.25 is taxable. 75,000 standard deduction. How much is the common income? Common income is 11.25. Therefore, after standard deduction, therefore doubly taxed income will be 11.25. Another example, say there is some PGBP income PGBP income also, and there is a loss also. PGBP income is 12 lakh, there is a loss of 8 lakhs, net income is 4 lakhs. Net income is 4 lakh. In foreign country, this 8 lakh is not allowed as a deduction, though there is a loss, full 12 lakhs is taxable. In India, it is allowed. In India, it is allowed, only 4 lakhs is taxable. How much will be doubly taxed income? Answer, 4 lakhs, whatever is common. However, if the situation is vice versa, for example, it is PGBP income 12 lakh rupees, and there is some PGBP loss 8 lakh rupees, net income brought back to India is 4 lakhs. In foreign country, this 8 lakhs is allowed as a deduction or loss, only 4 lakhs is taxable. In India, it is not allowed. Earlier example, in India it was allowed, now foreign country it is allowed, India it is not allowed. India, full 12 lakhs is taxable. Then also, same answer, doubly taxed income would be not 12 lakhs but only 4 lakhs. Simply, whatever is common between these two. This is actual, but we have to take into account whatever amount is commonly taxed in both the countries. So that's our next point. Only that much income will be taken into account, which is common income, shall be taken into account as doubly taxed income, as much as is subjected to tax in both the countries. So in these examples, what has happened is, in this example, 8 lakh of loss is allowed only in one country. Because of that, in one country only 4 lakhs is tax, another country 12 lakhs is tax. This country 12 is tax, this country 4 is tax. So common amount is 4 lakh rupees, which is taxed in both the countries. 8 lakhs remaining is taxable only in one of the country. Are you following this? Okay. Now this can happen because of either of these two. Either there is a loss or there is some deduction, either chapter 6 deduction or standard deduction from house property, standard deduction from salary. Some deduction is there which is allowable only in one country, not allowed in other country, or maybe it is allowed in both the countries. So let me take further example. In the same example, first example, it was allowed in India only. Second example, it was allowed only in foreign country. And third example, if I tell you 12 minus 8, 4 lakh rupees, it is allowed in both the countries. In foreign country also 4 lakhs is taxable. In India also 12 minus 8, 8 lakhs is allowed in India also, only 4 lakhs is tax. Then how much is doubly taxed income? Common income 4 lakhs. Meaning thereby, either the deduction or the loss is allowed in either both the countries or one of the country, then that much will be reduced from doubly taxed income. Simple language, common income to be taken into account, and in India we have to follow Indian income tax rules or Indian income tax law. We don't have to worry about foreign taxation law. Clear till here? This is an important point, keep it in your mind. Okay. Now the question arises that everything depends upon country of residence and country of source. So source country is one, but imagine if assessee turns out to be resident of both the countries. If he turns out to be resident of both the countries, which is quite possible, say everywhere world over the same rules are there, 182 days of presence. In India also we have 182 days condition. Some countries have 181 days condition, some countries have 183 days condition. And that is how it is quite possible assessee may turn out to be resident of two countries. In such situation, we have to put a rubber stamp, we have to finalize any one country out of the two. Then we apply something called tiebreaker rule. Tiebreaker rule is generally given in article number 4 of the relevant DTAA. Article 4, tiebreaker rule is applied differently for individuals and tiebreaker rules are applied differently for non-individuals, partnership firm, LLP, company, etc. If individual is resident of both the countries, then 4 points are there. He will be deemed to be resident of only that country where he has a permanent home available. However, if he has a permanent home in both the countries, then he will be deemed to be resident of that country with which his personal and economic relationship is closer. Now, closeness to personal and economic relationship is called as center of vital interest. With which country is center of vital interest is close. So, point number A contains 2 points. First, he will be deemed to be resident of that country in which he has a permanent home available. But within the same point, second part, if he has a permanent home in both the countries, then he will be deemed to be resident of only that country with which his personal and economic relationship is closer, center of vital interest. However, second point, if center of vital interest cannot be determined, meaning thereby if his personal and economic relationship is equally close to both the countries or not close to either of the country, then center of vital interest cannot be determined. Or in a situation where he does not have permanent home in any country, either of these two countries, then he will be deemed to be resident of that country in which he has a habitual abode. Habitual abode means a place where he or country where assessee habitually or regularly resides. If he has a habitual abode in both the countries or none of the countries, then he will be deemed to be resident of that country of which he is a national. National means nationality, that means citizenship. Up till now, if you observe, citizenship was never to be taken into account. Everything was based on residential status. First time, we are taking into account citizenship to determine the residential status. If he has habitual abode in both the countries or none of the countries, then habitual abode. And last point, if he is national of both the countries or none of the countries, then his matter will be discussed between the tax authorities or tax representatives of both the countries, and tax representatives, that is competent authorities of two countries, will mutually decide. This procedure is called as mutual agreement procedure, MAP. This is the story of individual. If he is other than individual, then only one possibility, residential status will be determined as per MAP, mutual agreement procedure, and if MAP is not followed, then he will not get benefit of treaty. So, tiebreaker rule can be understood this way, dividing people into two categories, individual, other than individual. If he is other than individual, then it is very straightforward, only MAP. But if he is individual, first priority to be given to, what are we discussing? We are discussing in case he is resident of both the countries, then we will have to put a rubber stamp and finalize any one country. We will have to make him resident of only one country. Which country? Answer, that country in which he has a permanent home. Permanent home is there in both the countries. Then personal and economic relationship, center of vital interest. If that is not determinable or permanent home is not there in either of the country, then habitual abode. Habitual abode is in both the countries or none of the countries, then nationality. National of both the countries or none of the countries, then mutual agreement procedure. Institute recently asked a 6 marks question based on this, where you had to reproduce this entire paragraph. Keep it in your mind. Okay. Now section 90 subsection 2. Section 90 subsection 2 states that DTAA provisions are specific provisions and local domestic law provisions are general provisions, whereby specific provisions will override general provisions. Meaning thereby, whenever income as per DTAA, let's say under tax exemption method, if income is going to be taxed in one of the countries and exempt in another country, let's say income is going to be taxed in India, then at what rate that income will be taxable, for determining that we'll have to apply section 90 subsection 2. 90 subsection 2 says that DTAA provisions are specific provisions and Income Tax Act provisions are general provisions, and as per universally accepted law, specific provisions shall override general provisions. So, by default, according to DTAA, particular income is taxable at 20% and according to Income Tax Act it is taxable at 10%, then by default we need to apply DTAA rate. However, DTAA rate in this example is 20%, income tax rate whereas is 10%. Then also by default specific provision. But 90 subsection 2 says that no, wait, if general provisions are found to be more beneficial as compared to specific provision, then to that extent assessee can seek application of general provision. Meaning thereby here, if general provisions are found to be more beneficial, then tax rate will be that rate, whatever is more beneficial to the assessee. Even though DTAA provisions are specific, Income Tax Act or domestic law provisions are general provision, and even though specific shall override general, then also we will apply whatever is beneficial. However, this is the story of income number 1. Suppose if I tell you where general rates are more beneficial, but if I tell you that assessee has one more income, second income, and for second income, first income tax rates are more beneficial, but for second income, DTAA rates are more beneficial. Then this comparison between the two for making a choice, comparison is to be made income wise, I mean for each income individually, that for first income you go for this rate, second income you go for this rate. For every income we have to make a choice separately, or we have to make a choice on an overall basis. Overall means what? Overall means for first income you calculate tax at this rate, plus you on second income you calculate tax at this rate, find out total tax on both the incomes under DTAA provision. Same way, the doubly taxed income into 10% for first income and second income into 30%. For both the incomes, you find out total tax as per Income Tax Act provision. This is total tax as per DTAA on both the incomes, total tax as per Income Tax Act on both the incomes. Now, comparison shall be made on an overall basis between these two figures, or comparison to be made individually. So, answer Rule 128 says that comparison shall be made individually. Therefore, for first income 10%, second income 5%, this is allowed. Why? Because of the language used here, whatever is beneficial, to that extent, assessee can seek application of whatever is beneficial, or assessee can seek application of general provision to that extent. The wordings to that extent indicates very clearly that to the extent of that income. This is also given in Rule 128. So, doubly taxed income to be taxed at lower of domestic tax law and DTAA rate, that is one point. Comparison shall be made between the two income wise and not on an overall basis. This is given in Rule 128. Plus here also it is very clearly given in 90 subsection 2. Supposingly, if I tell you assessee has one more income, third income, where the rate as per DTAA is 10.15, but income tax rate general provision is 10%. Which one is lower? Naturally, you will say 10% is lower. However, remember, Income Tax Act rates are required to be increased further by applicable surcharge and applicable health and education cess. Surcharge may or may not be applicable, but health and education cess 4% will certainly be applicable. Eventually, 10% will become at least 10.4%, 10.40%, and 10.15 will remain 10.15. DTAA rates are not to be increased further by surcharge and health and education cess. Now, which one is lower? Now, DTAA rate is lower. Simply, what I mean to say is that income tax rates are required to be increased further by surcharge and health and education cess, but DTAA rates are all inclusive, not to be increased further by surcharge and health and education cess. Okay. Now, this comparison shall be made for recipient of income also, as well as payer of the income, or only for recipient. So, payer of the income will be required to deduct TDS. So, supposingly Mr. A is making payment of 100 lakhs or liable to pay 100 lakhs to Mr. X, who is non-resident. Non-resident is coming from such a country with which India has a DTAA. According to section 195, whenever any resident person makes payment to any non-resident, then payer will have to deduct TDS. TDS will be at what rate? So, answer section 195 is applicable. TDS will be as per rate applicable to that income. Let us say it is 30%. However, as per DTAA, Mr. X is liable to pay tax at the rate of 5%. So, what will happen is, to Mr. X 5% tax rate will be applicable, but this 5% given in DTAA is applicable only to recipient of income, person who is non-resident. This 5% or this DTAA is not to be followed by payer. Mr. A has not to see anything of the DTAA. He will end up deducting TDS at 30%, 30% of 100 lakhs. This can create practical difficulty, whereby one solution is that let the TDS be 30 lakhs, let the tax payable be 5 lakhs, later on Mr. X can file IT return and he can show that tax payable is 5 lakh, TDS is 30 lakhs, he can claim refund of 25 lakhs. That is one option. Is there any other alternate way available? Answer yes. Alternate way is available. that it is clarified in section 90 subsection 2 that lower of the two tax rates, lower tax rate will apply not only for the recipient, will apply for payer of the income also. It is given in section 195, TDS shall be deducted at the rate given, that is rate prescribed, that is 30%, or at the rate applicable in DTAA, whichever is beneficial. Therefore, TDS will ultimately be 5%. Okay. So, that is lower of the two rates applies not only to the recipient of income, applies to deductor of tax also. Okay. Now, DTAA can be entered into only between two governments. Apart from government, other people cannot have a DTAA. But somewhere in 2010-11, Chidambaram ji was finance minister. He expanded the scope. He introduced section 90A with 2 points. First point, an agreement similar to DTAA can, apart from government, can now be entered into between specified association in India and a specified association outside India. Up till now, only one such association was there, Taipei Association, which is capital of Taiwan. Barring that, this point is totally unimportant. Institute has never asked question, future also they will never ask question. If you recollect, I told you there are 196 countries in the world. Out of 196 countries, India has entered into DTAA with 98 countries. 19 countries, 19 countries are tax haven countries like UAE, Brunei, Qatar. Many countries are tax haven. Saint Kitts, Cayman Island, these are all, or British Virgin Island. For tax haven country, it is pointless to enter into agreement because double taxation will never happen only. Then what to do by entering into agreement? The answer, the purpose of DTAA is not only to avoid double taxation, the purpose is also to have exchange of tax related information. The purpose of DTAA is also to cooperate with each other for exchanging tax related information so that resident of either country cannot evade tax or cannot hide his property in the other country. So, for that there are 19 tax haven countries. Most of them don't even have their own government. They have a monarchy system or they are controlled by some other country. Like British Virgin Islands controlled by USA, Panama Island controlled by USA, so and so. So, according to section 90A part 2, DTAA if cannot be entered into, not feasible, then at least an agreement similar to DTAA called Tax Information Exchange Agreement TIEA can now be entered into by Government of India with a particular country or a territory outside India. This is totally unimportant. Generally we do it with the tax haven countries. India has entered into such tax information exchange agreement with around 20 countries. Last 2 points, section 90 subsection 4 and 90A subsection 4. It says that earlier what was happening is, if somebody comes to me from abroad and he says he is from Mauritius, so I would apply Indo-Mauritius Treaty. According to Indo-Mauritius Treaty, tax rate is 0%. But how do I know that that other person, Mr. X, is coming from Mauritius only, that he is a resident of Mauritius? So up till now I used to check his passport and take an affidavit or undertaking from him in writing. However, it is quite possible that Mr. X is not a resident of Mauritius. He has been to Mauritius, he has a house also in Mauritius, but he is actually a resident of some other country, which is quite possible. It is not mentioned on the face of anybody that he is a resident of so and so country. What if that person is lying? Up till now, I would demand only passport copy and undertaking. Now, Chidambaram ji, before he wound up, he made a new rule, 90 subsection 4 and 90A subsection 4. He introduced something called TRC, Tax Residency Certificate, whereby when a person approaches me and says he is resident of Mauritius, I will not totally rely on him. I will tell him to not only show me his passport, but also furnish a certificate from foreign country, Mauritius, certificate of he being resident of Mauritius. Such certificate is called TRC. He will have to get it from the country of his residence. And 90A subsection 5 and 90 subsection 5, TRC is a must, not important from exam perspective. TRC is a must but not sufficient. There may be some other documents required, other documents or information as may be required to be produced by assessee, as may be demanded by department, and then assessee will have to furnish such documents. Correct? That's it, the chapter is over. One small point I would like to bring to your notice, which I generally teach in regular class with regards to DTAA credit or DTAA relief in case of unilateral. The last step, 6 number step, is doubly taxed income, but it is not only doubly taxed income, it is doubly taxed income included in NTI. So what do you mean by included in NTI? Included in NTI. So come to this example. There are 3 examples on your screen, A, B and C. Starting with example A. Supposingly Indian income is 5 lakh rupees and foreign income is 3 lakh rupees. Indian income 5 lakhs, foreign income 3 lakh. Gross total income is 8 lakh rupees. From 8 lakh rupees, Indian income is royalty and foreign income is house property rent. And supposing the assessee is eligible for deduction under 80 RRB, 80 RRB is a deduction allowed only to resident individuals for royalty from patents available up to 3 lakh rupees. Supposing the deduction is 80,000 rupees. Now this deduction and NTI drops down to 720. Now this deduction 80 RRB is called income specific deduction, meaning thereby it is allowable against particular income, royalty from patents. It cannot be randomly be claimed against any income. It can be claimed up to 3 lakh rupees only against particular income. That's why we call it as income specific deduction. Which income it is allowed from? So it is allowed against royalty, and here royalty is Indian income. Indian income is royalty. So 80,000 will entirely go away or entirely be allowed against 5 lakhs of Indian income. No part of 80,000 can be claimed against foreign income. Foreign income remains intact. So with this 7,20,000 of net income, if I have to ask you 2 questions, number 1, how much is the foreign income? Answer, foreign income is 3 lakhs. But out of 3 lakh, how much is included in NTI? Included in net income is also 3 lakh, because no part of this 80,000 was adjusted against 3 lakhs of foreign income. Entire 80,000 was allowed against Indian income. Same example, if I twist the characteristics of income, say Indian income is 5 lakhs, foreign income is 3 lakh, but this time Indian income is house property rent, foreign income is royalty. Foreign income is royalty. Gross income is 8 lakhs, 80 RRB is still 80,000, which is income specific deduction. Net income is 720. And now what will happen is, this being income specific deduction will go to set off against or will go to reduce particular income, which is royalty, and this time foreign income is royalty. So now what will happen is that foreign income, if I ask you question how much is foreign income, answer is 3 lakhs. But in step number 6, relief will be available only with regards to that much doubly taxed income as much as is included in NTI. Now how much is included in NTI? The answer, this time 80,000 deduction was allowed against foreign income, therefore amount of foreign income included in NTI is 220. And relief under section 91 or under tax credit method, the last step, step number 6, we will consider, though the foreign income is 3 lakh, relief will be allowed on that much doubly taxed income which is ultimately included. And if you apply your logic, you apply your brain, out of 3 lakh rupees, what is getting doubly taxed is 220. Because 80,000 is already adjusted. So foreign country 3 lakh fully taxed, in India only 2,20,000 tax. So how much is common income? Common income is 220, therefore doubly taxed income is 220. Though foreign income is 3 lakh, relief will be allowed with regards to 2,20,000. Last example, which is the most important, which I wanted to explain you. In the first 2 examples, we took 80 RRB, which was income specific deduction. So you have no option to decide. It will go to reduce that income only for which it is available. But this time it is ATC, other figures remaining same, Indian income 5 lakhs, foreign income 3 lakh, gross income 8 lakh, ATC is 80,000, net income is 720. Now ATC is a general deduction, it is not income specific deduction. Now the question is, which income should it be allowed against? Should it be allowed against entirely against Indian income 5 lakhs, or entirely against foreign income 3 lakh, or proportionately against Indian income and foreign income? Proportionately it will be 50,000 from here and 30,000 from here. Proportionately or entirely? Logically in the absence of any clarification, most students would agree that deduction should be 80,000, 80C should be allowed proportionately against both the income. However, that is a wrong answer. Remember, whenever act is silent, whenever any act is silent, then there are 6 rules to interpret the language, which is called IOS, interpretation of statutes, which you studied a way back in law subject at inter CA level. One of the rule out of the 6 rules of interpretation, one of the rule is beneficial construction, meaning thereby whenever act is silent, you should do whatever is beneficial. So here what is beneficial? If I set off against Indian income, that will be more beneficial, or setting it off against foreign income will be more beneficial. So if I set it off against Indian income as in example A, then my foreign income is 3 lakhs only, but foreign income available for relief becomes 3 lakhs. But if I set off chapter 6A deduction against foreign income, then foreign income subjected to double taxation gets reduced. And then though foreign income is 3 lakh, I will get relief with regards to only 2,20,000. This would be less beneficial for me. My tax liability under example B will be more, because in example A I am claiming relief. See, understand, all the 3 example net income is same, 720, 720, 720. Therefore, tax liability will be same. Therefore, average rate of tax will also be same. That way everything will be same. But in this situation, I will get relief only to the tune of 2,20,000 as compared to 3 lakhs. So this is less beneficial, this is more beneficial. So more beneficial, I am adjusting chapter 6A deduction against Indian income, less beneficial if I adjust it against foreign income. So what should I do in example C? In the absence of any clarification, it should be adjusted against Indian income, foreign income should be kept intact. So foreign income is 3 lakh and included in NTI is also 3 lakh, and accordingly I will be able to claim higher amount of relief as compared to 220. This point you need to remember. General deduction, do not try to set off against both the incomes, give first priority to Indian income. If Indian income gets wiped out, then you move ahead and adjust it against balance foreign income. This is an important point, will help you while solving the question, keep it in your mind. With that, this chapter is over, revision of this chapter is over. See you in the next video with the next chapter.